The live intraday stock price for Nuburu Inc., trading under the ticker BURU on the NYSE American Exchange, stands at $0.21185, representing a strong move higher of 3.54% today as of the market snapshot at 12:22 p.m. Eastern Time. Now, the common expectation for a stock priced this low and trading on the fringes of the exchange requirements is simple. It's a pure speculation play, a tiny, volatile bet on a long-shot technology that most investors write off as essentially worthless. But here's the insight the casual observer is missing. The recent trading action isn't about their legacy blue laser product at all. The entire volume spike and the dramatic volatility seen over the last 2 months, where the stock has bounced between a 52-week low of about $0.12 and a temporary high near $0.40, is almost entirely fueled by the company's very aggressive and ongoing pivot into the defense and security technology sector through a series of complex strategic acquisitions and partnerships, particularly with European firms like Techni and Orbit. The market narrative has quickly shifted from an advanced industrial laser company struggling for commercial traction to a nascent defense tech consolidator. And that fundamental shift in identity is the true driver of this stock's wild daily swings, forcing a reevaluation of the entire equity. The general belief among the retail crowd right now is that Nuburu is a highly dilutive micro-cap gamble, and that sentiment is entirely valid when you look at the balance sheet. They've faced ongoing NYSE compliance issues related to their share price and have consistently relied on equity financing to operate, which naturally raises alarm bells for existing shareholders due to the constant threat of dilution. This is the reality most investors cling to, and it's backed by the Q3 2025 financials, showing a net loss of almost $33 million. However, the contrarian, deeper take is that this capital is being deployed immediately and strategically to acquire actual, revenue-generating, or at least contract-backed defense and security assets. The flurry of announcements, the first €2 million tranche execution in support of Techni, the Phase 1 completion of the Orbit acquisition to gain a foothold in operational resilience software, and the planned drone joint venture with Maddox Defense all point to a management team frantically trying to outrun its cash burn by building a tangible, defensible business with higher margin potential in the defense space, a sector the original blue laser business simply couldn't access at scale. This narrative of a forced high-stakes restructuring and acquisition binge is what keeps the stock active, trading over 10 million shares today, demonstrating a high level of speculative engagement. This volume, while lower than the long-term average, is impressive for a stock at this price level and underscores the tension between the company's precarious financial position and its ambitious capital-intensive transformation plan. The recent stock movement clearly reflects this tension. Over the last month, the stock has traded with extreme volatility. We saw a significant move up in October when the Orbit acquisition was first announced, and then a subsequent sell-off that pushed the price back down, which is typical for a company funding its growth through public offerings, as the influx of new shares tends to put downward pressure on the price regardless of the positive news. The price consolidation we've witnessed lately, however, appears to be holding support around the 0.20 level, which is a critical psychological and technical threshold. This current intraday pop of over 3% suggests that the recent news regarding the Techni partnership's first funding tranche is resonating with traders who are focused on the execution of the new strategy rather than the old financials. The institutional ownership, currently sitting very low at under 1%, shows that the major players have largely avoided the stock, which is a key factor enabling the high daily volatility driven by smaller institutional movements and, crucially, retail trading and short seller activity. The institutional activity that is occurring, like the increased positions seen from firms such as UBS Group and Vanguard Group in the last reported quarter, albeit small in the grand scheme, is not selling off, suggesting at least a passive interest in the defense pivot. Now, let's address the short-selling awareness and actionable insights, because this is where the volatility really gets amplified. According to the most recent data, Nuburu has a short interest of approximately 17.3 million shares, which translates to a relatively low short interest as a percentage of float at about 4.02%. However, the days to cover is extremely low at just 0.40 according to the latest NYSE data. This is an important distinction. While the percentage of the float shorted isn't alarmingly high, the very low days to cover suggests that short sellers could close out their positions in less than a single day's average trading volume, limiting the potential for a sustained short squeeze. This is the reality check for retail traders discussing a squeeze on forums. The risk is that the daily trading volume is so high and inconsistent that a coordinated closing of short positions might not create the explosive multi-day upward pressure some are hoping for. Furthermore, the off-exchange short volume ratio sits remarkably high at over 56%, indicating that a significant amount of short selling is occurring in dark pools, which is a point of constant debate on online platforms regarding price suppression and transparency. Investors who are tracking this stock need to monitor the short borrow fee rate, which is the cost of borrowing shares to short. A sharp, sustained spike in that rate would be the true actionable signal of increasing short seller demand and limited supply, which could precede a sudden upward price movement. For the time being, the short thesis remains clear. The company is burning cash, profits are non-existent, and the ongoing dilution is an inescapable reality that justifies a sub-dollar share price. The counterpoint, driven by recent volume, is the company's clear and frequent execution of its new defense tech acquisition plan. You can find this data on financial transparency platforms. Understanding the difference between the short interest percentage and the days to cover is key to reacting responsibly. Do you think the high off-exchange short volume for BURU suggests a concerted effort to keep the price down, or is it just the normal operation for a highly volatile microcap stock? Comment below with your honest take on the rising short interest, smart money, or market mechanics. Moving past the immediate daily trade, it's important to understand the actual foundation the company is trying to build. Nuburu was founded on the promise of its proprietary high-power, high-brightness blue laser technology, which is genuinely interesting for advanced manufacturing. Its blue lasers are theoretically superior for welding and 3D printing highly reflective materials like copper and aluminum, a significant pain point for traditional infrared lasers. This technological edge, backed by over 220 patents, is their expectation for success. The reality, however, is that commercial adoption has been slow and costly, resulting in minimal revenue and substantial net losses, with the prior focus on industrial laser sales failing to achieve scale. This lack of commercial success in their core product is the direct reason for the dramatic strategic pivot into the defense tech sector, led by the formation of Nuburu Defense LLC. The goal is to leverage the blue laser technology where applicable, particularly in next-generation defense applications, but more importantly, to acquire established defense and security firms with existing contracts and positive cash flow. This is a massive directional shift. They are attempting to become a holding company for defense and operational resilience assets, hoping to gain revenue, scale, and management expertise that can stabilize the balance sheet and provide the necessary footing to survive and eventually thrive. The acquisition of Orbit SRL, a software-as-a-service company focused on operational resilience, is a perfect example of this non-laser, immediate revenue-focused strategy. The future outlook for Nuburu is entirely dependent on the successful execution of this transformation plan. Possible scenarios are extreme. On one hand, the company successfully consolidates the acquired defense assets, particularly Techni, with its existing $500 million contract portfolio, achieving the critical mass needed to stabilize revenues and eliminate the going concern qualification often attached to their filings. This outcome would validate the current speculative trading and could see the stock re-rate significantly higher as it sheds its microcap laser startup identity for a more resilient defense tech label. The catalyst here is the closing of the full Techni controlling interest and the realization of expected synergies, particularly the projected $100 million JV revenue by 2028. On the other hand, the primary risk is the failure of the transformation program due to a lack of available non-dilutive capital or a rejection of the proposed acquisitions by